Sean, it is very good to see you. This morning, we and the rest of the country are on Recession Watch. And I would like to start with a pop quiz with your recession take. So, A, we are already in one. B, recession in the next 6 months. C, recession in the next 12 to 18 months. Or D, we will avoid a recession.
I really want to give you option D. I would love to
I
avoid
want
the
you to
recession.
too.
And this is what the Fed is balancing this fine line right now between slowing the economy through its interest rate policy, but not slowing it so much that we get into a recession. I am concerned because they really missed the boat at the beginning of this interest rate hike environment. They kept telling us that inflation was transitory and it wasn't here to stay. They were
Mhm.
wrong, absolutely wrong. It's here and it's embedded. It's now they're raising the rates, and I do think if if this continues, and it needs to because of inflation, we're going to see rising unemployment, which will slow the economy down, and that will be recessionary. So my gut tells me we're going to see it within 6 months, maybe 9 months out.
Okay. All right. Well, I'm glad you brought up the interest rate hikes because I'd like you to take a look at some of those historical rates. The current rate of those interest rate hikes is the yellow line on the
Right.
left. We can see how steep that's been. So markets expect the Fed, Sean, to back off its hawkish stance unless inflation remains stubborn. Do you have any predictions then on those future rate hikes?
Well, I think we're going to see more. Even if inflation, let's say inflation stops rising, we're still going to be stuck at a 7% inflation rate, which is way too high. So the
Right.
Fed does need to increase rates some more to bring that inflation rate down. If we start to see inflation come in, if we start to see the economy slow, if we start to see some rising unemployment, which nobody wants to see, but right now we're at 2 to 3%, so we have to see some more. If those things happen, I think we're going to see the Fed slow down its rate of increases. They do have some more increases to go, but they may not be as big as they had been in the past. And that yellow line, which is nearly vertical, will taper a bit.
All right. Okay. So I want to bring up a little bit of good news though, because I think when we talk about recession, a lot of us feel a little bit anxious. The Dow had the best October ever. The S&P had the best October since 2015.
Right? Take it with a grain of salt. It did. I mean, both those indices did very well,
Hmm.
but since then we haven't seen them do well. Prior, they hadn't done well. We are in a I don't want to use the word transitory because that's what the Fed said, but
That's
we're
right.
transitioning from a high growth, easy money scenario to a slower growth, tighter monetary policy. And that means the markets are still trying to figure out what earnings are going to be, what growth is going to be for these companies, and these markets are going to continue to go up and down. And then we have other external situations, such as the war in Ukraine.
Hmm.
That's having a big impact on commodity prices. We've got energy issues there. We have China easing its COVID policy, which is good. That may actually help with inflation. Though China's economy is now going to come back and be more vibrant, they do supply a lot of goods to the rest of the world.
Right.
Perhaps it'll help drive down prices.
Okay. And as we talk about these rallies that we'll see, they often come after these low points. And I just want to remind everybody who's watching that you are backed by a team of investment experts at Brookstone Capital Management. And our CIO crunched these numbers for us. This shows a $10,000 investment over a 15-year period. And if you stay fully invested, that's the dark blue on the left. But if you miss just the 10 best days, Sean, it's incredible what happens to your money.
It's unbelievable. You lose more than half of that return.
Right.
And really, what happens here is the best days typically follow the worst days.
Hmm.
And if you try to time the markets and say, I want to get in or out at certain points in times, you're going to miss it. It's just human psychology. It's impossible. You might get it once or twice, but to systematically and repeatedly time the markets is a fool's game. You
Right.
can't keep up with it. So it's so super important to stick to your long-term plan and stay invested. If something happens in your life that changes your outlook or changes what risk you can have in your portfolios, then you make some changes, but have them be based on your personal fundamentals, not the gyrations of the market.
Right, right. And having a conversation with you, Sean, I always personally value because it does make me feel better. But I'm sure that if somebody has questions about something we've covered, or if they are feeling anxious, they can probably give you a call. But what's the best way to reach you?
Please call us at 603 715-2335. Give me a call. We'll set up some time to chat, and I'd be very happy to answer any questions or concerns that anybody may have.
Okay, Sean, thank you.
Thanks, Erin.